You know, we're about to dive into one of the most legendary stock market strategies of all time. But what's really wild is where it came from. It wasn't dreamed up in some Wall Street high rise. Nope. It was invented on the stages of a global dance tour. Pretty incredible, right? Okay, get a load of this number $2 million. And we're not talking about today's money. This was back in the late 1950s. A total market outsider took a small investment and turned it into this absolute fortune. I mean, to put that into perspective for you, that's like turning your money into over $20 million today. Just let that sink in. So that leads to the big question, right? How on earth did a professional dancer pull this off? I mean, this guy wasn't a banker, he wasn't some finance guru, so how did a world-famous dancer with zero formal training manage to crack the stock market's code, all while touring the globe? Well, the answer is surprisingly simple and very, very clever.
All right, so to really get the method, you first have to get the man. So let's meet the unlikely genius who came up with the whole thing.
So this is him, Nicolas Darvas. And by day, he was a world-famous Hungarian dancer. We're talking one of the best on the planet. But in his spare time, between shows, he got hooked on the stock market. And you've got to remember, this is the 1950s. There was no internet, no smartphones. He built his entire system using just telegrams and the financial section of newspapers. He figured out how to trade remotely, and as we already know, he was really, really good at it.
So what was his secret sauce? Well, it all boils down to this really simple, kind of elegant idea he called the Darvas Box. Let's unpack exactly what that is.
Okay, so a Darvas box is basically a container you can draw right on a stock chart. Here's how it works. A stock hits a new high, right? But then it kind of pulls back and just trades sideways for a bit. It's not really going up or down. That creates a range. The highest point it hit, that's the top of your box, the ceiling. And the lowest point it drops to in that range, that's the bottom, the floor. You can literally think of the stock as being trapped inside this box, just consolidating, coiling up like a spring before its next big move.
But listen, just having a box isn't enough. For Darvas, there were two key ingredients that had to be there. First, you need the box itself, that clear sideways movement. But the breakout, the moment the stock tries to escape the box, meant nothing without the second absolutely crucial ingredient, volume. I mean, a surge in volume. When a stock broke through the top of that box, it had to do it with a ton of trading activity. For him, that high volume was the signal. It was the confirmation that big money was getting interested and that this move had some serious muscle behind it.
Okay, so we've met Darvas, we get the idea of the box. Now for the fun part. Let's put it all together and see how this actually works as a step-by-step trading strategy. You can really break his whole method down into 4 simple steps. Step 1, he was super picky. He only looked at companies in booming, high-growth industries. Step 2, patience. He would just watch and wait for a box to form. Step 3, the trigger. The second that price broke out of the top of the box, with big volume, he was in. He bought. And finally, step 4, the exit, was just as disciplined. If that stock even dipped back into the box, he was out. Sold. No questions asked, no second guessing. And this right here is probably the true genius of his whole system, his risk management. So as a stock kept climbing and forming new, higher boxes, Darvas would just trail his stop loss right underneath the bottom of the most recent box. It's so simple, but it did 2 amazing things. 1, it let his winners keep running up as far as they could go. And 2, it locked in his profits and made sure a small pullback never turned into a big loss. It's brilliant. Okay, but let's be real. No strategy works all the time, and Darvas himself was the first to admit that. So it's super important to understand not just how the box works, but also when it's likely to work, and maybe more importantly, when it's likely to fail. So the good stuff is pretty clear, right? The system is easy to understand, it makes you incredibly disciplined, and it absolutely shines in a strong bull market where everything's trending up. But, and this is a big but, the downsides are just as real. If you try to use this in a choppy, sideways market, you're just going to get chopped up with a bunch of small, annoying losses. This thing needs a clear trend to work its magic. And we can't forget, it was born during one of the biggest bull runs of the entire 20th century. So with all that in mind, you might be wondering, why are we even talking about a strategy from the 1950s? Well, it's because the box itself is really just a vehicle for some truly timeless trading wisdom. And this is the real gold right here, the philosophy that's even more important than the boxes. First off, he was a pure trend follower. He never ever fought the main direction of a stock. Second, he only paid attention to two things, price and volume. That's it. He lived by that classic trading rule we all know. Cut your losses fast and let your winners ride. And finally, he kept things incredibly simple. No clutter, no overanalysis. And you know what? These principles are just as powerful today as they were 70 years ago.
This quote, it just says it all, doesn't it? My only reason for selling a stock is when it is not acting right. Think about that. He didn't sell because of a scary headline or because some expert had an opinion or because he got a bad feeling. He only sold based on what the stock itself was doing. If it broke his rules, if it fell back into that box, then in his mind it wasn't acting right anymore. And poof, he was gone. It is the absolute definition of trading without emotion.
And that kind of leaves us with a really interesting question to chew on. Look, today's markets are a different beast entirely. They're way faster, way more complex than anything Darvas ever saw. But the human emotions that drive prices, all that fear and greed, that stuff hasn't changed one bit. So in this modern world of algos and high-frequency bots, could a simple box and some old-fashioned discipline still be a recipe for success? What do you think?